Well, I'm hopeful that there's no surprises, and I don't think we're going to be surprised by performance, our performance. I'm hoping there's no surprises in terms of margins or provisioning or costs or the quality of the earnings is going to be a big issue. Where the earnings are coming from. There's no doubt Australian banks appear to be well managed, but they are excessively have excessively grown into the housing market, the residential lending market, and we know the capital issues around that, the benefits they have. I don't think that's good for the economy. I don't think excessive amount of gearing going into the residential property market when residential properties had such a huge run and the multiples of earnings being paid for property in Sydney at record highs. I don't think it's very clever to have a financial system which is so levered into the residential property market. But as I keep on saying, we don't have regulation in this country, and it's like, see what happens type of attitude. Now, there's no reason to expect that the housing market will have any problem, cause any problem for the results we're about to see. There's no evidence of that. But the excessive pricing of housing and the excessive leverage in the household sector tells you we don't have room to have any mistakes. And that's probably my biggest worry. It's not about what we're going to see in the next couple of weeks. It's the developments which are going to happen in the Australian economy over the next year or so, whether we can hold our property prices, because clearly people are stretching to buy property with leverage. And we've created this problem by international investors, negative gearing, and government support for first home buyers. It's all built up into what we've got.
Is there a time over your time in the market where you can remember where you've seen a setup that's been similar to what we see at the moment?
No. And I maintain that the world economy and the financial engineering is unlike anything. I mean, there's some nights at home and at night I just go, what am I looking at here? This just... now I hope I'm not alone. I mean, I hope I'm just not sitting there wondering. I think a lot of fund managers, asset managers are going, what are we dealing with here? I try to convey that to my clients. I mean, this is not easy. Yes, there are fund managers out there who are making exceptional returns by trading their head off. But that's great, and they go through cycles. What Australia needs and what our superannuation investors need are quality long-term investments. And what I see as a struggle here is getting those investments at the right price. Australia's a great place to invest. We've got natural growth levers, so there's no better place to invest. But right now I struggle to see, at this point in the cycle, why you want to invest there. But then I look at overseas and I say, yep, I have an interest in having non-Australian dollar assets, but I don't like the economic settings I see in offshore markets. They are truly bizarre. And I only wish the Australian authorities and the government would be open enough to say that those policies are unacceptable to us in Australia, and we're going to look after ourselves until you guys overseas fix up your problems. We shouldn't have the open economy we have in a world which is clearly not open or not fair. I'm all for open economies, but when everyone's behaving themselves, that's not what is happening today. And I've never seen the like of it before. This is quite unique. Well, they're being forced to chase returns. I mean, we all want to make money. But and I think Stevens is right on this. I mean, as you've driven interest rates into the ground in Europe and Japan and America, you're creating real stress on investors to try and get a reasonable return elsewhere. Now, a balanced asset portfolio has, yielding bonds, cash, deposits, corporate debt, property, equity, goes right across the risk spectrum. Once you chop the returns on low risk assets to zero or negative, you're forcing capital across the risk profile. Yep. And people all of a sudden think that the returns they should get should be the same as a bond, but they're taking a lot more risk to get a similar sort of return to a bond type yield or bond type investment. Or they're buying, by that I say they're buying excessively priced equity for a fairly mediocre return. So their risk profiling on the returns they're getting are extremely high. Now what we're trying to say to our clients is just be aware of the risk. We'll manage the risk. You don't need to be fully invested. You shouldn't be fully invested, but you also need to be spread, in Australia, out of Australia, a bit of yield where you can get it, and don't give up. There is a place for cash even yielding 2.5% at this point in the time. it's not a clear-cut case of where we're going to make money. The world is on a wander-through process, okay? Just be aware of that. And don't be greedy. You know, we're all hopefully going to live 20, 30, 40 more years. You know, the capital we don't lose today will be the capital we can invest tomorrow, and that's where you'll make your returns. So it's very much about not making mistakes in this cycle, not being too aggressive, or certainly not being greedy, and not having an excessive view of what you can generate in terms of returns. Tough times.